And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA CIB, proud sponsor of GTR Africa 2025. ABSA is a registered FSP. Your story matters. Good evening. Welcome to The Money Show tonight. I'm Stephen Grootes on a day probably going to be remembered for the fact that the gold price went through $2,970 for the first time. $2,976.08 an ounce as I speak to you now. One does wonder if this is the late surge people have been waiting for to take it past $3,000 for the first time. And of course, the tariffs coming out of the White House are a big part of that. And I think that's going to be one of the big talking points tonight in your investment school this evening. We'll actually talk about how you invest during a recession. This is something that Americans may need to start preparing for. The other big story that I think is developing, and you might have heard this on Radio 702 this afternoon, but it does seem now that the National Treasury is confirming that because the Finance Minister, Enoch Godongwana, officially said in his speech yesterday that there will be a 0.5 percentage point increase in VAT. That is, in fact, now the law. It would require an entirely new act of Parliament to overturn that. It seems almost impossible to get such an act through before the actual deadline. I think it will be the 1st of May. Chris Axelson, the Acting Deputy Director General for of the Tax and Financial Sector Policy Unit in the National Treasury, confirming that. This comes out of a Business Live story. It does tell you, of course, what that suggests is that this VAT increase is going to happen. Whether the DA wants it to or not might well change the negotiating position of some of the parties in all of this. But I'm also reminded of what Charles DeVette, the tax specialist, told us last night on The Money Show, that many businesses are not set up to be able to implement a 0.5 percentage point VAT increase. They could do 1%, but not 0.5%. And that, I think, might lead to some compliance issues. We'll speak to Sim Chabalala in a moment. Also, of course, don't forget the situation in Exxaro. Ben Magara coming back as a CEO. You'll remember, of course, his time at Lonmin, a very difficult time at Lonmin because of what happened at Maracana. But he now will be the new CEO at Exxaro. And then, of course, just watching the situation regarding the European Union, that summit meeting happening now between President Cyril Ramaphosa and the leadership of the EU. We'll be finding out a little bit more about that as we continue the show. Clearly, the EU looking at multilateralism, looking at more trade with South Africa on a day in which the US President Donald Trump has said that he'll impose a tariff of 200% on all EU beverages because of an EU surcharge on American whiskey. Getting very real in international trade at the moment. 100,000 people, we understand, earn over 1 million rand a year and are not registered for tax. Who do you think it is? 011 883 0702 021 446 0567. A free nothing if you say taxi owners. And of course, voice notes tonight on 072 702 1702.
702. Stephen is on The Money Show.
6 to 8 p.m.
Well, Standard Bank saying they're bullish about their future, bullish about the country's future too, after reporting it saw growth in its South African business of 12.5% in the year to the end of December. Its dividend up 4%. Number of active clients in South Africa up by 4% as well to over 20 million. The bank also reporting its Africa business, the numbers not looking quite so good, partly because the rand was stronger. That offset any gains in local currencies. The CEO at Standard Bank is Sim Chabalala. Sim, good evening. Welcome back to The Money Show. You say you had strong organic growth. Your number of active customers is up. Where are those customers coming from? Are they coming from other banks, or are they maybe new to banking or new to a particular product?
Stephen, always fantastic to chat to you, and thank you for having me. In South Africa, the combination of clients comes from, firstly, yes, existing competitors. Secondly, from new-to-bank customers. And thirdly, more customers holding more products with us, which is generating that growth. So it's a combination of new entrants and taking from competitors.
A big part of this is the way you're managing your relationships with clients, call centers, digital channels. You're clearly competing with other banks in this space. I mean, how difficult is it to stay on top of that game, to ensure clients walk away from that interaction feeling pretty good? Basically, what I'm really asking you is the cost of good banking.
It's a combination of things, Stephen. So firstly, you know that we have invested a vast amount of money in our technical capability. You remember that our intangible asset on the balance sheet was roughly 21 billion rand a few years ago. It's now reduced, as you know. Secondly, we spend about 22 billion rand on IT costs, which range from cloud to license fees to premises costs to staff costs. And importantly, we've used all of that capability to improve the client experience. In the retail bank, that is focused on always being available to our clients, making sure that they're able to transact whenever they want to and need to, and we've done very well on that in the last few years. Secondly, always making sure that we're offering people the right contextual offerings for them. So when somebody's making a payment for their daughter's university education, we know that they need to perhaps buy a flat, to pay for the airfare, and so forth. And so making sure that you're having appropriate conversations with clients at those important moments in their lives. Improving the ability for people to do transactions sitting at their homes on their app. And we've got an app that is working very, very well for our clients. Giving clients access to borrowing. So you make an application for a loan on your app, and we can disperse in 30 minutes. All of those actions and those activities, improving the quality of our staff, giving them the appropriate training, making sure that they've got the appropriate tools so that they can have the right conversations with clients, all of that has contributed to that increase in customer numbers and increase in customer satisfaction.
Banking is getting more competitive. You know that better than I do. Are you expecting to have to innovate quite strongly to keep your position here?
We are having to innovate all the time, Stephen. The competition is the incumbents, the mighty First Rand, Absa, Nedbank, African Bank, Discovery Bank, and then the new entrants, Time, in partnership with New Bank, Bank Zero. This is a fiercely competitive environment. And in fact, the telcos are providing payment services. The retailers are providing payment services to clients. And so the average South African consumer has got a vast array of propositions available to them. And so to win in that environment, you need to be innovative, providing clients with the right solutions at the right time and at the right price.
Your businesses across the continent didn't do quite so well in rand terms. I presume currency fluctuations were a bit of a factor in that.
Indeed. I have to say, however, that they were 22% up in constant currency, but like you correctly say, when you convert the Nigerian naira, the Ghanaian cedi, the Angolan kwanza into rand, it showed you that diminution, so that we ended up with 1% down from 18.2 billion to 18 billion rand. However, all of that we think is going to normalize. Each of those countries I've referred to had challenges. You had massive inflation. You had the devaluation of the naira as that country was restructuring its foreign exchange arrangements. You had Ghana going through a very, very difficult time. You had oil price challenges for Angola, all of which will not repeat in 2025.
You suggest that while we may see some disruption from the tariffs imposed by the Trump administration, you expect this kind of turbulence to be temporary? Was that the word? I mean, that's quite a confident thing to say at this stage.
No. Can I give you the detail of what I said and what I mean?
Sure.
The proposition is as follows. We've done modeling, as has the central bank, the SOB, as have the IMF, to check what would happen under various scenarios. And the scenario our team has looked at is to say, okay, at the moment, tariffs are on all goods are roughly 1.5% globally. Shock that and take it to 10% and see what that would do to global economic activity, to African activity, and to South Africa. And our calculation is that it would have a diminution of 0.1% in South Africa, GDP, and in Africa, outside South Africa, it would be 0.2%. Now, 0.2% on $3 trillion, which is African GDP, is a large sum. It would affect households and it would affect businesses, but people would manage around it. difficult, painful, but I think it would be manageable, is the real point. And another point from history, Stephen, is to say we've seen tariff wars many times in the last century. And certainly in the case of the United States, you saw the Smoot-Hawley tariffs in 1929. The point being, you have tariffs, but people adjust, is the point.
I mean, you still seem to forecast a stronger rand by the end of the year.
And that is because the rand is undervalued on fundamentals.
Sim Chabalala, thank you very much indeed. Really appreciate the time. The CEO at Standard Bank on The Money Show this evening.
The Money Show on 702.
Monday to Friday, 6 to 8 p.m.
Well, in the aftermath of the budget, a comment today from the SARS Commissioner, Edward Kieswetter. He believes there are 100,000 people in South Africa who currently earn over R1 million a year and are not registered for tax. In the budget yesterday, SARS got another R7.5 billion over the next few years to improve its system so it can go after people who haven't paid their tax. Elmine Tharon is an Associate Director for Tax Consulting at Forvis Mazars. Elmine, good evening to you. I mean, would you agree with this figure? 100,000 people, R1 million a year who aren't registered?
Good evening, Stephen. Yes, that's quite a big number. And one would ask the question, where was this number and how was this number determined? But I can imagine that there are some measures that was put in place, and I think that this number has probably been determined by looking at monitoring of movement in spending by individuals and also obtaining information from financial institutions.
I realize SARS is getting more money, but I presume it's not quite that simple. I mean, you can give them more money and say catch more people, but you need real investigative capacity. You need people with forensic experience to catch people who should be paying tax but aren't. It's not a sort of 2-year thing. It's probably a 5 or 10-year thing to build that capacity.
Absolutely. I think that SARS is really investigating in making sure that the systems are in place in order to analyze information. And I think that's specifically with regards to the flow of funds. I think it's probably going to require the employment of data analysts for extraction of relevant information. And I also think that there would probably be a separate team that's going to have to do the investigations, meaning that there's definitely going to be an increase in employment by SARS.
I presume, Elmine, you tell me, I presume there's no country in the world where everyone pays exactly the amount of tax they're supposed to pay. Is there a sort of compliance target we should aim for? I mean, I presume if, for example, you get to 95% tax compliance, getting that last 5% would be very, very difficult and very, very expensive.
Absolutely. I think that it's more to catch those individuals that are not paying tax at this point in time. And I think that there's probably some measures that SARS can put into place. They've indicated that those that have been paying tax and been assessed, 98% of the individuals were happy with the assessment. So it's more towards making sure that the net is catching the individuals that's not paying tax at this point in time. We've looked at a voluntary disclosure program for companies that's still in place, and maybe that is a suggestion that SARS can come up with a type of voluntary disclosure program for individuals where they come forth with not paying taxes in the past and to come forward with this voluntary disclosure program. Alternatively, SARS can look at imposing higher penalties for individuals that's in debt at SARS or is not paying tax. And then obviously one can look at the SARS system in handling debts that's also owed to SARS that hasn't been settled. So there is ways that SARS can encourage individuals to come forth with respect to paying their taxes.
Elmine Theron, thanks very much indeed. Associate Director for Tax Consulting at Forvis Mazars. Listening to that, Kaya Sithole, the Chartered Accountant and Independent Political Analyst. Kaya, good evening to you. I mean, if you were going to look at sectors where people might earn this kind of money without being registered for tax, where would you look? And let me just say, I do have a few ideas of my own.
So I think, in essence, we would be looking at the type of sectors where too much of the economic activity is not easily traceable, either economic activity that can operate outside the ambit of formal, transactional systems. And I imagine that when you go to places like nightclubs, for example, where you can imagine that people can indeed be able to buy and trade in alcohol without it necessarily being registered through the systems. That's just one example. But I suspect the bigger fish would be in places where people are able to engage in transactions based on South African products, but are able to do so using offshore entities and offshore currencies. So if you and I, for example, set up our bank accounts or some structure in Mauritius, for example, we reach a meeting of the minds that we'd like to exchange a house here, so I'm selling the house to you, but then we simply do the exchange, the transaction, or the exchange of cash flows outside the country, and all I have to do is to give you a piece of paper acknowledging my new ownership or your new ownership of the house. So that's just one example where we can be able to do this without necessarily being subject to the scrutiny of the South African authorities. And of course, if they can't scrutinize it, they can't value it. If they can't value it, they can't tax it.
I mean, I presume that SARS is going to get a lot more capacity. Do you think it's a good investment?
I think it's a necessary investment, and obviously, firstly, the investment that we've given SARS in the past few years was firstly to rebuild capacity, and I think you can say that was basically getting them to the baseline that they were in probably before a guy called Tom Moyane walked into the building. Now, beyond that, it's now the question of, well, we've got a particular tax system, we've got particular tax policies and a particular tax architecture, but it feels that we're leaving some money on the table. That is the view of the commissioner, who says it could be as high as 800 billion rand. And of course, if he's true to his word, and even if it's wrong, even if it's half wrong, that's a lot of money. So if it's going to require some additional resources to get him to collect an additional cent, it is definitely a rand worth investing in. It's also quite important that in the past few years, we've been tracking what the cost of collection is. In other words, how much it costs to administer SARS compared to the type of amount of taxes that they collect. And that number has been gradually declining. Now, you could say that they're becoming more efficient, or on the alternative, if they're not given an additional resource, then of course that number is still going to decrease. So we need to be able to find the right balance between the amount of resources allocated to them and the taxes that they collect.
There's still going to be a big political argument over the 0.5 percentage point VAT increase, and there's a suggestion in Business Live, in fact, from Chris Axelson, the Acting Deputy Director General for Tax and Financial Sector Policy Unit at the National Treasury, that because the Finance Minister said it yesterday, it is the law and therefore can only be overturned by another law, and there's no chance Parliament would get another law passed in time. This is surely going to be a factor in any negotiation or arm wrestling or whatever we want to call it between the ANC and the DA.
Yeah, I'm also quite surprised that somebody would call it a law, because actually all that we had yesterday was a proposal. Proposals get debated in Parliament, they get voted in, and only then do we end up in the ambit of it being called a law. So obviously, if bureaucrats and National Treasury are of the view that that's obviously something that's guaranteed to happen, that's a separate matter altogether. But I'd caution against saying that every pronouncement made by a minister is a law. It actually just doesn't work like that. There has to be some procedural steps. We understand that those procedural steps might indeed be finalized and might indeed be, something that everybody knows is going to happen, but it is still a required step. So, of course, at that particular point in time, once we have it, then the question of what do we do next, it is indeed a question that requires some political decision-making. And if the political decision-making is to change it or to update it later on, then that's a new process that we have to engage in. Obviously, if it says the tax is coming down, no one will object to that. If you say more taxes, then there's definitely a lot of political trading that you're going to have to do. And the fact that we had to wait 3 weeks indicates just how difficult that conversation is these days.
Kaya Sithole, thanks so much. Really appreciate it. As you know, the finance and political analyst.
The Money Show.
The Markets.
Viv Govenders, Portfolio Manager at Rand Swiss. Viv, good evening to you. When I checked an hour ago, let's call it, the gold price was $2,970. That was a first. An hour and $8 later, the gold price $2,978.10. Just $22 away from $3,000.
Oh, yes, and I fully expect it to break it in the reasonable future. I think that gold right now is looking attractive for a number of reasons. Not only the fact that it's a nice safe haven, asset in an environment where previous assets that are considered to be safe haven, like the US dollar, are experiencing, well-known difficulties. I think also what's happening with crypto, to a certain extent, the fact that we've seen some of that crypto, excitement kind of disappear, but also help it out. And I think finally the disturbance we're seeing in the world with regards to, like I said, the dollar, means that maybe central banks out there are looking at, gold more with more interest, because, you just don't have the US currency as the basis of your foreign exchange reserves.
And while we talk about gold, the Nasdaq is down another 1.63, was down 4% earlier in the week. The Dow Jones down by over 1, the S&P 500 down by over 1. How far down do US markets go?
Well, the fall has been substantial from the recent highs. We are down the S&P 500 almost 10%. But if you go back to basically the day before Trump was elected until now, the market is down basically about 3% or so. I think a lot of the stuff that happened, especially over the last over the few months after Trump win, where markets ran quite strongly and things like Tesla went up, quite significantly. That I think was not based on any kind of real, I think fundamentals. And what we're seeing right now, maybe it's more of a return to sanity than anything else. I think that yes, Trump has not been great for the market. Has not been great for for the stock prices. Tariffs and etc. are not obviously positive. But if you look at basically the moves that happened after the election, how would you justify Tesla basically doubling in price because Trump was elected? Unless you assume that Trump was going to make Tesla the official car of the US, it doesn't quite make sense.
Certainly doesn't seem to be the case. Not very popular in Europe at the moment. Standard Bank, you might have heard some Chabalala just a little while ago. He's very bullish about the future for his bank, and the share price jumping quite nicely on their earnings.
Yeah, look, the Standard Bank has had, obviously, a bit of a similar shine removed in terms of their, even though they're the biggest bank out there, because we've seen the rise of the Capitex. We've seen First Rand, for instance, do rather well. I do think that, the banking sector overall needs the country to grow quite nicely. And unfortunately, over the last, little while, we have not really seen that come through in terms of economic growth. And so, yes, we have seen a bit of, positivity in the last year or so. We have seen, I think the performance last year for Standard Bank is about 15%. But we need to see the economy as a whole grow so we can see our banking sector really take up quite strongly.
And very quickly, Exxaro, they're getting a new CEO, Ben Magara.
Yeah, look, this is another area where things are looking a bit more interesting. I think what's happening in the world around, commodities is, quite an interesting thing. Things are under pressure over the last year. I do think that there are signs of optimism in the commodity sector. A lot of stuff is happening on the world with onshoring, friendshoring, and the model of commodities. China seems to be getting out of its own way in terms of economic growth. That might also be positive for commodities as well. But there remains issues globally around the fears of recession, which are obviously going to also affect it going forward.
Viv Govender, thanks very much indeed. Portfolio Manager at Rand Swiss.
The Money Show
with Stephen Grootes.
Well, good to hear from you tonight. If you were tasked with looking for people who are earning money but not registered for tax, where would you start? I have a few thoughts. 011 8830702 0214460567. Big announcement out today from Exxaro Resources appointing Ben Magara to be its CEO after the difficult departure of Nombasa Tsengwa following that court battle. You'll remember Magara, of course, from his time during that very difficult period at Lonmin. Exxaro also reporting today a 36% fall in annual profit, partly because there was lower demand for coal from Eskom. Riaan Kopaskar is the acting CEO at Exxaro Holdings, normally the Chief Financial Officer, I understand. Riaan, good evening to you. A big drop in annual profits. What led to that over the last financial year?
Thanks, Stephen. So there's a couple of reasons. First being commodity prices are down. So if we look at our export coal prices, they are down 13% compared to 2023. Then also, as you know, we are still challenged with logistical challenges. So exports, we did increase our exports during the year, but we did have to incur additional cost. So the additional cost for exports amounted to 1.4 billion rand. And then also remember, we are a shareholder in Sishen Iron Ore Company, a subsidiary of Kumba. So their profit also declined by about 45%. So if you put all of that into the mix, basically you get to the decline in our profitability.
The logistics headache that you're dealing with and other mining companies are too. We understand Transnet is improving, but you suggest you're using alternative distribution channels. Is that literally trucks carrying coals on national highways?
Yeah, it's not on national highways. So what we've got is we've got a multimodal transport where we truck to a central location and then we put it onto trains. So it's mostly coal that in that way will then go to Maputo Harbour. So that is one of the options. But what we are fairly confident is with the rail reform now taking place in South Africa that the situation will improve at RBCT, but even assist us to export more coal through these alternative channels as more and more private players may be able to get access to the railway lines.
You're in the wind generation business as well, if I remember, and you're obviously diversifying. I presume coal mining is still going to be one of the cores of your business for a while? Quite a long time, in fact.
Yes, no, definitely. At this point in time, if you look at our profitability or our EBITDA, coal is still about 90% of the business. So we are growing the energy business. We did announce the Karreebosch transaction where we will add 140 megawatt of generation capacity. We are still looking at our mineral strategy where we are looking to get into transition minerals. But coal will still be the bedrock for the medium term.
Riaan, it's been a difficult period in your business for other reasons, and I'm talking about the departure of Dr. Nombasa Tsengwe, your former CEO. We saw the claims about a toxic workplace culture. I think she feels, certainly from her public statements, that she was hounded out. That must have been very disruptive.
Yeah, so all of that was handled at the board level. So it was not handled at the executive level. So I think the executive got on with business, and all of the other matters were handled at board level.
I can see I'm not going to get very much from you about that, Riaan, but I do understand what you say. Ben Magara coming in as CEO. He's dealt with very difficult situations before. We all remember him from Lonmin. He's done some other things. I suppose you will be reporting to him when he comes in, but what would you suggest his priorities should be? Are there some things that maybe need to be done urgently at Exxaro?
Yeah, so we're very glad that Ben is coming in. As you know, Ben is already on the Exxaro board. He's also, for instance, the chairman of our investment committee. So he already knows what the issues are at Exxaro and what he needs to attend to. So I think when he comes in, it will be nothing new. It will be addressing issues like logistics, also making sure we optimize our operations from a cost perspective.
Riaan Koppeschaar, thanks very much indeed. The acting CEO at Exxaro Holdings. Big changes, of course, there tonight. 9 minutes to 7.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking, proud sponsor of GTR Africa 2025.
Well, good to hear from you this evening. In Cape Town this afternoon, and I think some of the discussions are still going on, the President, Cyril Ramaphosa, hosting the EU Council President, Antonio Costa, and the EU Commission President, Ursula von der Leyen, for the EU-SA Summit. Obviously, both sides talking about trade and about a word that is not very popular in some parts of the world at the moment, multilateralism. Dr. Kagiso Poe is a public policy specialist at the Wits School of Governance. Kagiso, good evening to you. I mean, I don't think the main speakers mentioned him directly, but I presume the main reason the summit is happening is because of US President Donald Trump. Is he pushing South Africa and the EU closer together?
No, evening. Yeah, look, he's no longer the silent elephant in the room. He's just the elephant in the room. And yeah, he literally is the cause. I think it's more of a rethink of how trade is going to go forward, especially between EU and South Africa. And the key thing being, how do they become closer allies? But I think there is a bit of a missing context within that conversation, I think, which is to say there's a reason why the EU finds itself in that particular situation. And I wonder, while I agree with the South African government that this discussion is important, the EU is also a bit of a declining force. So it's to be interesting to see what South Africa can extract. Because whether we do like it or not, while multilateralism is what we're going for, at the end of the day, this is a very extractive relationship. And if you are simply just being a goody-goody two-shoes without getting anything for your country, it might not be the best way to do things.
I mean, we do a lot of trade with the EU, right? It's China, the EU, and then the US, I think, is about half of that. But we have arguments with the EU over all the time, and particularly about oranges, because, and let me be blunt here, maybe I can say it and you can't, because the Spanish don't want our oranges, okay? They bring up this thing called black spot, which is a tiny disease that has no impact on humans. But I would think that if you're dealing with this very carefully, as President Ramaphosa I'm sure is, he would be trying to extract everything he can from the EU, because they're knocking on our door for a change.
Yes, and that's why I think it's almost like the perfect opportunity. I'd written an article actually saying this, that look, if we don't really extract, and obviously there's a bit of finesse in how you extract these things. You don't simply do what I think President Trump is doing, because America does have the might to be able to do that. But things like what you've mentioned, which is to say the EU has always had these barriers to trade. It's actually a bit of a misnomer. The European Union is not actually for free trade. There's so many rules and regulations which stop our products from going into there. That what part of what Trump also argues is what you just mentioned, that listen, the EU is so rigid in certain instances that they can pick one little thing, which you've correctly said, like the oranges, which has no material or health side effects, and they can make that the biggest issue because they're protecting their farmers who they subsidize. While if you were to do the same thing as a South African farmer, the EU would say, listen, we have a serious problem with that. So the key issue should not be that we just throw ourselves into the arms of the EU. Should be, what can we get out that helps our farmers? And most importantly, and I think this is probably what I'd love to know about this discussion, what about the discussion about critical raw minerals? Because the EU is going to be very desperate for those minerals, and because that's going to be the big thing for the 21st century. How do you get those minerals into places like the EU?
I mean, the EU is in a position now. I mean, yes, their stock market has done very well over the last 3 months, better than the US, which is a sort of reversal of what we've seen for a very long time. But they need to rebuild. They need to rearm as well because of what's happening with Russia and Ukraine and the US attitude to all of that. We've heard from one or two people on the Money Show recently who suggest the EU could actually surprise to the upside. I mean, is this a game we need to play carefully? We need to make sure we're actually stay sort of hitched to the EU in a way, and at the same time send a nice, big, bold statement together against Trump?
I would probably put it the other. I think it's almost like hedging your bets. I think we do need, when we're discussing with the EU, I think the key issue that we also need to keep foremost in our mind is the EU is actually a declining force. They're two big animals, they're economic animals. Germany and France are actually in a bit of chaos. What we once knew as Germany, the big automobile industry, has been heavily affected by the Chinese coming in. And if you now hearing things such as VW and many of these German industries are closing some of their factories at home. So you don't really hitch your wagon to a declining force. So what we should be doing is say, what can we give the EU and what can they give us in return that kind of compensates for some of our weaknesses? Where we should be looking for bigger trade, I would argue, is the ASEAN region, which is the East Asian area, your Vietnams, your Singapores and the like. So we should be friendly to everybody, and this is the true definition of non-alignment. I rather call it delinking, which is we should be saying, where can we really grow our industries of the future? And the future is going to be in places like Asia, your Vietnams and your Indias. That's where we should be concentrating on. But what we should be doing with the EU is to say, what can we, in the meantime, we give them such that they open up their markets to what we already have as our supply chain. And look, we cannot ignore the US. It's a bald eagle that you simply cannot ignore. So for me, it's more like we're going to need a bit of tact. And the key issue of how do we hedge our bets for the future and in the interim to sort out the problems which we currently have.
I mean, within all of this, of course, is our relationship with China. And I've been sort of expecting that almost automatically, if the US pushes us away, and they might kick us out of AGOA, for example, it would probably push us closer to China. I don't know if it's quite that simple, but it seemed to me to be quite a likely outcome.
No, it is also, if you remember our BRICS relationship. And like you did state earlier, and I think China, if we had to look at it per country, not so much a bloc, China is our largest trading partner. But again, what we should really learn from this period in time is to say that, look, the Chinese don't simply come in with charity as well. A lot of, going back to the 90s, a lot of the mistakes we made with our textile industry, yes, no one can compete with the Chinese on price, but that should be a lesson to say you simply don't just open yourself up. The countries that do well in trading with the Chinese, and here I'm looking at the Australians, is you need to almost extract the value to say, listen, it's fair game. There's certain things that you want. But when we want industry, when we want foreign direct investment, the key issue we're looking for is employment and upskilling. And the Chinese are quite open to that if that's what you negotiate at the forefront. And sometimes I felt that in our negotiations with the Chinese, it's been more ideology rather than actually a strategy. So while the Chinese are going to become a bigger role player, we need to define what role it is, and it cannot simply be that we just open our markets simply so that you can cover what the US is going to take away from us. Because if we do that, we're simply finding ourselves in a similar situation with a different country.
Dr. Kagiso Poet, thanks very much indeed. Really appreciate it. Public policy specialist at the Wits School of Governance. Plenty to come in a moment. We'll talk about Meta's new community notes, why it's in the US but doesn't seem to be operating here. We'll talk about strategies to build resilience for smaller companies. And then don't forget Investment School tonight, how to invest in a recession. You're with The Money Show. It's 7 o'clock.
And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA CIB, proud sponsor of GTR Africa 2025. ABSA is a registered FSP. Your story matters. Good evening. Welcome to The Money Show tonight. And of course, lots of conversations around the gold price, around what's happening on US markets, around what's happening with our budget negotiations as well. And of course, difficult to know exactly how all of that is going to pan out. Lots of conversations too around the negotiation process and whether or not we are in fact going to see some kind of shift. Just an update on the gold price for you. Now, $2,982.71 an ounce. I mean, it passed $2,970, sort of, let's call it 2 hours ago. So really is moving up very quickly, partly, of course, because it is clear that the Trump administration is not going to stop its march towards more tariffs. Threats now of more tariffs from the US against EU products around alcohol. And it just does seem, in fact, that gold really is marching ahead very, very strongly. Lots of speculation it'll break $3,000 at some point. We'll talk more, of course, about that in the coming days. We'll talk about small business in a little while, how to get through this period, a very tough time for many small businesses at the moment. And then Investment School this evening. How do you recession-proof your investment portfolio? People using the R word in the United States, not using it here, let me be clear, but people, of course, very, very concerned about what's happening in the United States and just how difficult this is all going to be. You do get a sense of a sort of recalibration, if you like, in global trade, and just sort of thinking about what Dr. Kagiso Poet told us a little while ago, that, you know, it's one thing to put tariffs, one thing for the US to say we don't want to trade with, well, pretty much anybody, but they should not be surprised that there'll be a response to that. And I keep making this point on a regular basis. The amount of trade between two countries on a historical basis has never been bigger than the amount of trade we see between the United States and China right now. I mean, it is just an exceptional amount of goods flowing from one to the other. And of course, money and all the rest as well. And you can't really stop that suddenly. This has grown up over a very long period of time. And so just, interesting to see how these changes pan out. Good to hear from you tonight. 011-883-0702 and 021-446-0567. We understand 100,000 people in South Africa earn over R1 million a year and are not declaring it. They're not registered for tax. Where would you start? You heard Kai Satole's suggestion, the nightclub industry. Let me be clear, the taxi industry, not the drivers so much, but the owners. We all know why it's a cash-based business, don't we? You don't know? I think you might be able to work it out.
The Money Show
with Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
and DSTV channel 856.
You may remember some time ago Meta, or the owner of Facebook, saying that they were going to remove fact checkers and were instead going to have what they call community notes. That led to a whole conversation around the role of social media in disinformation. Siphumelele Zondi is our tech expert. Siphumelele, good evening to you. You're going to have to stop me at the beginning on this. What are community notes?
Hello, Stephen. Firstly, I need to have a disclaimer that I'm still in traffic, been in traffic in heavy rain out in Durban for a bit, but we can check. So community notes basically are a way for the public itself to sort of correct and share information about whatever it is that is posted on social media. It's sort of like different from what used to happen before. You started with fact checkers, right, in the beginning. So I'm going to take you a bit back to COVID, where people would post stuff, and then if the social media platform found that there could be untruths about what was posted about COVID, it would go and find a news article or something written by journalists, let's say, who have done stuff on Eyewitness News, for example, and link that to say, you can read this, it's going to give you correct information, or yes, you are correct, but there's more information that you've left out. Here's a link that's going to give you more information. So community note is basically the public now having the ability to be the self-checker, if you will.
I mean, what was wrong with fact checkers? I mean, I realize that they were kind of, trying to stop the sea. I mean, there's just so much of it. It seemed impossible. But was it not working? Or was it just, was it just Mark Zuckerberg currying favor with you-know-who?
Well, you remember how fact checkers also came into being. There are a lot of complaints about disinformation and misinformation on social media when those fact checkers came into being on different platforms, really. And of Donald Trump's first it ever come back. Some social media platforms even kicked him out of those social media platforms. So there is that accusation that with being started with X, right, removing fact checkers and introducing community, and that is now expanding on the 18th of March. It's going to be meta platforms, Facebook and Instagram, that are going to start doing this on the 18th of March. And there is that accusation that it's probably because of the return of Donald Trump, and we do know that sometimes what he thinks, whether it's factual or not, he would post it. And if you then have news organizations correcting it, or fact checkers saying, hold on, read this article, it might go against what the president of the United States of America is known for a lot of the time. So the public can correct him or not, and basically share different information about whether they agree with what he would have said or not.
I mean, X is something similar, right? As sort of community notes, users are expected to kind of correct. Does that work?
So X has it now, right? And I suppose there is a view that says it does work. And yes, it probably does to an extent that you can get different views from different members of the public who could share various information. So it could be your views even if I disagree with you, I can then go and share my own community notes. And I suppose a member of the public can say, well, there's Phumelele's view, then there's Stephen's view, and I can make up my mind based on those views as opposed to relying on information that would have been shared by journalists.
I mean, I suppose, in a way it depends on who does what and how it all works. Is it possible to know who is more trustworthy? I mean, which works better, the kind of community through notes or fact checkers who are supposedly professionals?
I suppose that you would think that journalists would have done their own research, and they would have gone to look for their own information, right? So we would believe that that journalists would probably be more reliable as opposed to an individual, because just now we're talking about the president of a country who at a certain point in time would have false information on social media, and he would have to be corrected by journalists or with information that would have been verified by traditional media platforms.
I mean, it gets very complicated. Why are they not launching it internationally? It's not worldwide, as I understand it, Siphumelele.
So what they've said is that they're starting in the United States of America, and it's a test in the United States of America, and whatever happens there, and they want to perfect it in the U.S. They said, and if once they've seen what's the perfect method of these community notes is, then they can start rolling it out in the rest of the world. So that's what they've said. They've said that they basically want to figure out what the best method is with working with community notes.
It seems to me that one of the things that's happening at the moment with all social media, whether it be X and Elon Musk and his chainsaw, whether it be Mark Zuckerberg, partly because he went to the inauguration and was so prominent there. So was Jeff Bezos, of course, as well. But the kind of legitimacy of people who own social media is coming into question. I don't know if this has an impact on the number of users. I understand the number of users of X has certainly declined. I know people are talking about Blue Sky as an alternative. I don't know if that's taking off. But is there a sense that maybe social media just isn't as powerful? It's still obviously huge, but doesn't shape the debate as much as it used to?
Definitely, and there have also been questions that have been posed to Blue Sky as well on whether right now they're seen as an alternative and as a cleaner alternative. But the question is, not also going to somewhere down the line sell to a billionaire who has different motives, because all these other social media platforms now are owned by billionaires, whether it's a billionaire that founded Facebook or whether it's a billionaire that went and bought Twitter and turned it into X. So there is that question on credibility and whether money does not end up controlling these social media networks, whereas the intention in the beginning is that it's always controlled by the community, and the community would determine what it wants to post. But obviously it changes somewhere along the line. So yes, to answer your question, credibility and the reputation of social media networks is being questioned right now.
The other thing that I find fascinating is that people, there are economies around these things, right? And they can change very quickly. We saw that TikTok was sort of banned, then unbanned in the United States. We've seen X change quite fundamentally in a 2-year period. If you have put your entire sort of life's work into building a profile or something on one of these things, that could turn out to be quite dangerous.
And also if you've created a profile, right, and a profile that is known for a particular thing, because what also ends up getting promoted as well on these platforms, because it does seem like the content that's been pushed in the last month, for example, on X is a particular type of content, and you might have content that doesn't speak to the platform again. And as you say, that at a certain point in time, there were issues with Donald Trump as he was going to leave as president of the United States of America. And that's why certain mechanisms were introduced. Now, all those mechanisms that were introduced then are being removed. So, yes, it does seem to switch and change based on who is, in this case, controlling the United States of America, controlling the platform based on money and whether they have bought that platform or not. And also it's survival, I suppose, for those that are running these platforms, because we have seen a hard hand, especially coming from the United States of America, towards a lot of tech companies, whether it's banning them outright, or outright rather, banning them outright, or whether it is sort of like tightening a few things or controlling how they actually function.
Siphumelele Zondi, thanks very much indeed, our tech expert. Really do appreciate the time on The Money Show.
The Money Show on 702.
Monday to Friday, 6 to 8 p.m.
Just a couple of thoughts about banking, if I may, for a moment. And you heard some Chabalala earlier on the program. A couple of days ago, we spoke to the CEO at Nedbank, Jason Quinn. We've spoken to others. We spoke to Mary Vilakazi as well from First Rand. Just about the ease of banking and how important the science of banking is becoming. And I'm sort of struck by a conversation conversations we've had with the CEOs of supermarkets. The science of shopping is becoming more and more important. And in banking, it would seem to me that as it becomes more competitive, we get new banks, the old mutual bank is coming, etc. You would expect that a lot of money and time is going to go into the science of it. And you put that together with the conversation we had with Alex Thompson, the CEO, the co-founder of Naked Insurance, your shapeshifter last night. You get a sense of how important it is to get that science right. The customer needs to walk away a feeling that they kind of got the better end of the deal, that they were well treated. I think a lot of money, time, and energy is going to go into that. The competitive advantage is going to be about that over the next few years. I mean, what would make you stay with a bank or go to a bank or keep going to a particular supermarket or getting them to order from you? Or why you keep ordering from them, rather? 011 883 0702 and 021 446 0567.
702. Stephen is on X.
At Stephen Grootes.
Small Business Focus is brought to you by Capitec. No matter the size of your business, Capitec's got you. Well, you know how difficult it is at the moment, and just a couple of ways to get through this period if you are running a small or medium-sized enterprise. Megan Dedekant is the area manager at Business Partners Limited. Megan, good evening to you. A couple of sort of ways, strategies to get through this period, and one of them for you is to create a financial margin.
Yes, thank you, Stephen, and evening to everyone. There's various challenges and risks faced by our SMEs on a daily basis. And, I believe one of the best ways to prepare for any unknown risk is ultimately to focus on what you know and what you can control. So at the end of the day, every business is different, and as such will have different risks that it would face. So I believe going back to basics, in the business, understanding what your business is about and what you can do. For instance, like understanding your income streams, knowing your gross margins. This knowledge can ultimately help you look at, for instance, diversifying your income streams so as to not, for instance, be fully dependent on one stream, or maybe the other way around, refocus your business to focus on certain streams that create the highest margin. You can obviously also look at your overheads, see where you can cut back, ultimately remove unnecessary expenditure. And this is ultimately to help you create that financial buffer. At the end of the day, we all need to have a few months savings available just to help us bridge those cash flow gaps, in the times when things don't always go according to plan.
And a big part of it now, of course, is around new technology. And I mean, technology, it used to be that new technology was very expensive. Often new technology now is not that expensive at all.
Without a doubt, again, technology, AI, digitization, whatever you want to call it, has a massive impact on all of our lives, including our small businesses. And again, technology is moving, it's changing at a rapid rate and has become part of consumers' daily lives. So our small businesses need to use these technologies in their businesses to their benefit. It can be anything from, again, your cloud-based type accounting software systems, your CRM systems that can integrate, for instance, all your financial transactions, your point-of-sale systems, all your payments, so that you can, for instance, see your daily sales, see your stats, all the way to doing your online stores, your online sales. At the end of the day, customers, they have become accustomed to on-demand service. We all want instant gratification, and technology becoming cheaper enables our SMEs to ultimately have that swiftness that they need to service their clients to the best standard that they can.
I mean, and clients expect it now, don't they? They expect you to be on top of technology.
Without a doubt. Again, our teams as well. I think if our SMEs at the end of the day can look at training their staff, developing their team skills, upskilling their employees so that they can be prepared and ready to adapt to any industry changes, these technological advances, any market shifts. Our staff need to be ready for any opportunities, particularly in digital literacy, any emerging technologies. Our staff need to be ready. So we need to empower our teams to ultimately work efficiently, to come up with new innovations, new solutions to maybe solve client problems. So I think ultimately to look after our staff, train our staff in new technology as well, will help us retain our clients and become more client-centric.
Yeah, I mean, I'm going to come to client-centric in a moment, but I mean, part of it is around continuous training for your staff. People need to feel they're learning something at work, and when they're learning something at work, they'll serve their customers better.
Again, just that I mentioned earlier now, we need to prioritize our staff. We need to prioritize employee development. Again, twofold. I think, this helps with high employee productivity. It engages your staff. It helps them, again, to upskill, become more efficient. And again, it brings our teams together, and I think through this, we can provide better solutions to our SMEs and ultimately engage more clients and hopefully improve our turnover and our bottom line.
And then becoming, completely customer-centric. I was making the point a moment ago around supermarkets and banks. I mean, that's what they've done quite successfully in some cases, is they've made sure that they really are about their clients.
Again, without a doubt, I was listening earlier, and you know what, SMEs need to focus on service excellence. You need to be in the face of your client. You need to know your client. You need to understand your clients. You actually need to get to know them on a personal level and seek those meaningful interactions. In the same breath, you need to reward customer loyalty, and you need to understand their pain points. At the end of the day, what is sales other than understanding the pain points that your clients have and solving these pain points with your product, and becoming more and more client-centric, to me, is vitally important. So, again, and this is going to go against what I said earlier for technology, but as much as technology is massively important for us to be swift, to be quick, to remain current, we need to also maintain personal face-to-face relationships with our clients as well. So I am still a very big believer in one-on-ones, getting to know your clients, and knowing them personally. I think there you will always have a loyal client if you actually know them on a personal level.
And then, of course, the R word, I don't mean the one that's stalking American markets. I mean resilience.
Yeah. Again, resilience, I think, comes back to what I mentioned earlier. Resilience is ultimately planning, knowing your business, and then by understanding your business and understanding the risks that face your business, you can then ultimately become more resilient for whatever diverse risks may be there. So be it cyber attacks, regulatory changes, political risks, whatever it may be. All of these items do ultimately filter down. They do impact your business. So we need to understand them and how they can impact us and ultimately build those necessary frameworks to protect our business and build those financial buffers, So, resilience is essentially planning, and helping ourselves safeguard our business, safeguard our operations so that we can maintain stability in what is ultimately an unpredictable world.
Megan, thank you very much indeed. Megan Deerdekant is the Area Manager at Business Partners Limited.
The Money Show.
Investment School.
The Investment School is brought to you by CFI, a leading global trading platform now available in South Africa. CFI Financial is an authorized financial services provider. Well, I made the point. No one is in recession yet. But if you look at the sort of R word in the United States, you get the sense that the storm clouds may well be gathering. There was a comment by, I think it was the chief economist at JP Morgan yesterday, suggesting that, in fact, if Trump continues on this current course, there's a sort of 40% chance of a recession in the United States this year. A massive reversal from where things were just, call it 3 or 4 months ago. At the same time, if you look at what's happening in U.S. stock markets right now, you can see, of course, that they seem to almost be pricing in some kind of trouble. Nasdaq is down 2% as I speak to you. It was down 4% earlier in the week in one day. So it does just suggest that there are problems. Joining us this evening to discuss how to invest in a recession, Vincent Anthony Raja is the CEO and co-founder at Differential Capital. Vincent, good to see you again. Thanks so much for coming in.
Thanks for having me, Stephen.
I suppose what we're looking for is principles to follow in this moment. If you are about to enter a recession, or if you're in the middle of a recession, and at some point there's always going to be another one, then how do you invest, and how differently should you invest from sort of quote-unquote normal times?
Yeah, no, it's a great topic. I don't know if it's going to be recession times as yet, but you're certainly right. I think the markets seem to be pricing in some turbulence, and so it's probably a useful time to revisit some of the observations through history. So a long time ago, I actually wrote a research paper with a good colleague of mine who I still work with today, actually, about 15 years ago. And there's a common metric that a lot of investors use. It's called beta, which is the sensitivity of a stock or an investment to the market as a whole. So if a beta is very high, so above 1, if the market moves in a certain direction, it's more sensitive than the market. And a low beta is something that has a low sensitivity to the market. And that sort of gives you a rough rule of thumb to say you want low beta stocks when the market is weak and trending down. But we took that research a step further to see, because the problem with markets is they don't crash upwards. They tend to crash downwards and slowly, they don't rise as quickly as they do fall. And what we found is there's an interesting phenomenon in that there are groups of stocks that when the market particularly crashes, they crash much faster than the market, and they don't necessarily catch up as quickly on the way up. And that's probably, if you are worried about a recession, you'd probably want to avoid those groupings. Maybe the most obvious one are the banks. And what happens during recessions is that bad debts rise. Banks don't have the fattest of margins, even though we think that they charge us a lot of interest. The reality is the margins that the banks make is actually quite thin. So let's call it if bad debt charges, which is the cost of, let's call it the percentage of loans that fail, go up by as little as 0.5% of your loan book, that can hit your profits quite badly. So what happens is the market tends to get worried about the banks. And as we've seen throughout time, banks also go bankrupt during recessions. I think the Reserve Bank's been pretty good over the last few years. So one of the things that you can do is, if you're really worried, generally the banks are the one sector that you can stay away from. In the past, insurers also used to be really bad, because insurers used to have guarantees that they give their policyholders. Now you can imagine if the markets are crashing, those guarantees become more valuable, obviously to the policyholder at the expense of the shareholder. So those are, let's call it, interesting groupings of stocks that you generally should try and avoid if you think there's going to be a recession or a sharp market crash. And then you're probably going to ask what's on the other side.
Yeah.
Good old fashioned gold. And unfortunately, it's amazing. They actually have what's called we call that thing negative co-skewness. In other words, they tend to rise when markets crash. So we just found that fairly interesting. There was other interesting groupings of stocks which were really SAB. So that was an interesting one. And
so in other words, you mean the brewery?
Yeah.
So beer is always going to be sold.
Beer is always going to be sold. Yeah. So I think when you look at, let's call it your stock portfolio, that's probably how you'd want to be thinking of tilting it. And then there's other things which I think you'd probably want to look at is actual, gold ETFs, physical gold. I think those have proven over time to be resilient during market crashes. So that's simplistically how I'd look at it. Yeah.
So I mean, in a recession, should you just be trying to retain your value, your wealth, or should you be looking for growth as well? And I mean, what this really gets to is, do you go as sort of safety first? I'm going to put my stuff in whatever Warren Buffett puts his stuff in, and I'm just going to do that. I'm not going to knock the lights out. I'm not going to do anything like that. I'm just going to stick it where I know it's still going to be in a couple of years' time.
Yeah, there's a number of hedge fund managers in South Africa that I see this chart popping up quite often, But what it says is that if you were to miss at least 50% of the downside on the 10 worst days of the stock market over a period of time, you outperform tremendously. And the reason is because, if the market is, down 50%, in order to get back to parity, you need the market to double, right? So if you can miss the downside and try and participate as much as on the rebound, your ability to then outperform is really good. So I think the aim, I see nothing wrong with trying to time market crashes because they often are quite signposted pretty well. The rumblings do come through. I remember the GFC was signposted probably 18 months before it actually happened, and if you started to position more defensively, you could have saved yourself.
The global financial crisis, yes. 2009. The big short.
The big short.
Yes.
And I'm not saying you could have gone short and made money on the way down, but what I'm saying is you could have, to your point, Stephen, rather try and defend than try and be clever and short during those times. Because what we do find is that when markets do start recovering and you're stuck in that bearish mindset, your shorts can blow you up too. And so, my general rule of thumb is try and aim for defensive positions, defend your portfolio during times of market weakness. I think it's probably an easier strategy than trying to pick real losers and then short them, which is what you can do on most online share trading portfolios. It's called CFDs, so you can make money on the way down by shorting it. I think that's a really difficult game to do on a macro basis.
During a period like that, so say, for example, a recession lasts, just because, for the math's sake, a year, as opposed to, say, what we've had over the last 3 years before Trump, okay? Do people, or is it advisable to trade less? In other words, if you're trading defensively, do you put your money into certain stocks and just kind of keep it there? Whereas in a boom, you kind of might be looking for, well, there's another, nth percent more value here or there, so I'm going to trade a little bit more. Is there any difference in the amount of trading activity? Let me put the question rather like that.
Yeah, personally, I found in my experience, we tend to trade more during a recession. And the reason is during that time, stocks reset wildly. So to use the example that I had about banks, you'll find that as quality an operation as a bank is, the markets will sell them off, most of them, indiscriminately. And so if you've been defensively positioned going into that, what you want to be doing is be building your bank positions in those times. So after the crash happens, and let me describe to you like the anatomy of how the market digests a recession. It's almost like the market very quickly prices in the recession. So the recession might last a year, but the stock market moves can happen in a month. And there you go, your recession is priced in, and then the recession eventually happens. But it's during that period where you start to see, the usual green shoots. And it's these stocks that have been probably hit too hard on the way down, that are quality, that you can have great opportunities to pick them up. Going back to let's call it my personal principles around investing is, if you've now successfully defended and then you reassess the investment landscape after a crash, you should be willing to trade more because of the opportunities that are available. They can be immense. So if I take the last crash just after COVID, I mean, there were some, I don't want to say obvious, but let's just take Sasol as an example. It totally crashed because remember, oil was negative for a while. But
yes.
But as the recovery happened, there were some things that we could observe, and you didn't have to be, an AI specialist or a data scientist, but you could see that a lot of people were starting to use their own cars as opposed to public transport, and that was probably more prevalent, especially in developed markets. You could read about it. Even though people were working from home, they were still using their own transport. And what happens to oil demand? It went up, So, a stock like Sasol that is very much dependent on that, which got, really hit in the crash, you could look at it. Another example was MTN, because MTN strangely has an interesting relationship with oil because of high dependence on a high part of its profits come from Nigeria. and Nigeria tends to fall out of bed when the oil price falls out of bed. So you tend to see MTN crashing during those times, and everybody thinks it's going to be the end of MTN. But again, it's when that crash happens, you want to be going into those kind of quality companies like that. So, yeah, long story short, Stephen, I would expect you if you're paying attention, you should be trading more during those times.
When you are thinking of sort of defensive investing, does it matter how old or new the company or the sector is? And let me give you an example. So everyone's been talking about NVIDIA. Okay. Would you rather during this time invest in Unilever? So would you rather invest in soap powder than washing powder than you would actually in AI during a recession?
Yeah. So I think that's a great question, Stephen. And I think the conundrum lots of investors are facing right now is it's a similar debate, but you've got Richemont, which is trading on a 27 times price to earnings forward. And at least on the expected earnings, NVIDIA looks optically cheap on a 22, 23. So I think this is where your understanding of the underlying business model is critical. So if I had to look at NVIDIA specifically, I think there's a lot of, let's call it secular trends that, irrespective of recession or not, I think quite perversely, the cheaper it becomes to develop AI tools like a DeepSeek, the more likely it is that we're going to see more use of the chips that NVIDIA is building. So, just my personal view is that, leave aside the stock prices and the valuation at this point in time. In my view, a business like NVIDIA, as new as it is probably going to be as defensive, probably more defensive, in my view, than a luxury company at this point.
Is that just because some waves are not going to stop? I mean, MTN was on the cusp of a cell phone wave when cell phones came in, and the sort of sense would be NVIDIA is that whereas washing powder is washing powder, and I mean I can't see AI changing it much.
Yeah, I think you're right. I think there's certain business models. I think like you said, the washing powder. I mentioned the beer companies. Those things are robust regardless, and I think on a relative basis, you can always find your staples that will be defensive. Your really good food producers as well fall into that bucket. So, yeah, I think it boils down to the product rather than how long the company has been around. Conversely, you can also find companies that are new, and you're right, but that are very, in my opinion, cyclical. An example, in my view, would be an Airbnb. It's a new, very successful platform. But the truth is, I think Airbnb is probably subject to a lot of cyclical trends as well. If travel drops when a recession happens, I would think that they would get into a little bit of trouble too.
We're speaking to Vincent Anthony Raja tonight, the CEO and co-founder of Differential Capital, on Investment School, how to invest in a recession.
Fayez will find you the finest Fiat, or if you prefer Volkswagen, Philip is your person. Sandile will help you go all out on a Suzuki, while Jason has your back if you're looking for a JAC. You see, our people know their stuff, and we know our people. We know that without them, there are no happy customers. There are no sales, no service. Our people are our passion because they know people like you. Bidvest McCarthy people deliver always.
Welcome to Schmidhauser Group for all your construction, electrical and plumbing needs. Competitive rates, free quotes and technical expertise come as an inclusive service when using Schmidhauser. A family-run business since 1978, we pride ourselves offering top quality and service excellence. Call now on 021 4244 588. Available 24/7. Schmidhauser Group. Swiss ingenuity, South African pride.
The Absa Cape Epic, Africa's untamed mountain biking race, is finally here. This Friday, the Money Show will be live from the start of the Absa Cape Epic, one of the toughest mountain bike stage races in the world. The riders will face 8 days, 700 kilometers of rugged terrain and 16,000 meters of climbing. Tune in for all your live updates straight from the starting line. Catch the Money Show live from the Absa Cape Epic this Friday from 6 p.m.
The Money Show.
Investment School.
Speaking to Vincent Anthony Raja tonight, CEO and co-founder of Differential Capital. Your topic, how to invest in a recession. Vincent, I presume the way that money can move around the world now, it also depends where you are and where the recession is. So during the global financial crisis, it was kind of everywhere. If in some places you will have a recession, I mean, Australia's famously never had a recession. I mean, apart from cricket. But, you know, there must be some places where you can sort of move money around. So if there's a global recession, and if America does sneeze, the chances are that there would be a kind of global recession, or something similar to that. Does that change the way you manage things? Or do you just put all your money into, of all places, Europe, which I'd never have said 3 months ago?
Look, I think every recession has been interesting. And if I go back to, again, my career experience is sort of the global financial crisis and the most recent one. But the global financial crisis was interesting because, during that time where the world was totally falling apart, you might have heard of this small country called China that just, it's just switched on its engines. And I remember there was a strategist that used to work with us that started showing us just simple pictures of the amount of luxury watches that were getting, pushed to China, and the inventory build-up and things like that. So that's why it's important. That's why I love paying attention to data, particularly around recessions, because you find that if one country is generally collapsing, and typically it's due to things like leverage and being it's kind of the things that threaten the US right now, right? You'll find that there are countries on the other side of that trade, and that's why it pays. It like I said, most recessions are different, and that's why it pays to pay attention to, let's call it the different geographies and what's going on. You're right. If we just focus on Europe right now, they might have something, let's call it two things in their back pocket. So I think an interesting trend to watch in Europe now is the rearmament of Europe. Now, it's not a good thing, but economically, when an entire continent decides to rearm itself, there's an interesting company called Rheinmetall, which actually has operations in South Africa.
They're a national key point.
Yeah,
Yes.
Exactly. So, and you have a look at what that share price has done, is incredible. So I think that could be one positive impact. So regardless of the recession, it's just that they have this, you can call it a secular trend in their favor. And the other component is, I think if there is potentially at least a ceasefire in Ukraine, and who knows, maybe peace with Russia, I think, let's call it the energy crisis that's been crippling Europe, could be resolved, and you have some interesting, let's call it base dynamics, which could help that continent. So I definitely think it's one to watch. So yeah, and I think that could be the difference this time round if there is a recession here. I also find that there's certain Southeast Asian economies that also have sort of lagged in recent years. Some very small ones, like for example Sri Lanka of all places. I know it's a frontier market, but I mean last year did tremendously well in dollars. So and it's, interesting things happening there as well. So I find that there's pockets geographically that you can look at. And then maybe if I just switch to asset classes again, sorry, I talked about gold and different kinds of stocks. I also find that good old-fashioned government bonds, depending on the government, of course. And as a South African investor, I think there's a episode we spoke about not too long ago on bonds, and but I think something as useful as a government bond which pays you an interesting and a healthy interest rate, or a coupon as they're called, I think is also really worthwhile looking, because what you find is that during recessions, even the bond yields rise, so the returns that you can get on them are pretty good. So I think it's important to also pay attention to other asset classes besides just obsessing about stocks.
We're always told whenever we speak to Warren and Grimm in personal finance that we must diversify. During a recession, do you almost find that you have a slightly less diverse portfolio because you're already out of banks and insurance companies? So do you find that actually you end up maybe not having quite as wide a spread, if I can use that phrase?
No, I think you should always have a spread across industries because, where it's kind of difficult, I think, to pinpoint, again, within sectors. So, within the bank sector, you might now start to concentrate a bit more in banks, but I wouldn't, put all your ammunition in one of the banks. You should have a spread of them and geographically as well. So I think, in my opinion, diversification is always your friend. Unless you've got extreme information advantage, I would say it's better to always try and keep a healthy level of diversification going into the recession, during the recession, and coming out of it. Because things always go wrong in investments, in any market, by the way. Yeah.
Vincent, thank you so much. I found that really valuable, really intriguing. How to invest in a recession will be available as a podcast. Vincent Anthony Raja is the CEO and co-founder at Differential Capital.